Students, purpose of this video is to go through chapter 19 with you. So again, I've been trying to make these videos all day and I'm hoping this time it works. You might be saying, but wait, why are you doing chapter 19? We just finished chapter 17. Well, we're going to come back to chapter 18 when we're in class together. It's income taxes. And in my mind, income taxes is the last thing before net income. So it makes sense to do that as our last piece of the income statement. So this is about chapter 19, which is going to be around pension expense and pension obligations. You've got your normal page with the objectives. And then let's start by just talking about the two key terms. All right, so you've got two types of employee benefits that we're going to deal with in this chapter, and they both relate to retirement. You have what's called defined benefit, and that's the tough one, and I'll tell you why. And then you have something called defined contribution. Right, so in both of these, employees work for a company, and in addition to their salary, they're hoping to have some sort of benefit that will help them in retirement. When companies offer a defined contribution plan, what that means is that, for example, the employer will say, hey, if you work for me this year and you put, let's call it 4% of your salary into a retirement account, such as a 401k or a Roth, we will come in and we will match that amount. And so the employer is contributing cash to your retirement account that you manage, right? And usually they sit at places like Fidelity or Schwab, etc. So the employer's cost or expense is really limited to how much they put into those accounts for you, right? And how much they put in is based on an agreement that they have with all of their employees, such as, like I said, if you'll put in 4%, we will match that 4%. When they put that money in, they debit expense and they credit the cash. Remember, the cash is going into your retirement account at a company such as Fidelity. At that point, it's yours. You can do with it what you like within the parameters of those retirement accounts. That's easy peasy. What's hard is this concept called defined benefit. And when we think of defined benefit, we think of pension, right? You might have heard of the term pensioners. They're living on a pension, right? They've got a pension plan. Well, what that is, that's different. That's where you work for a company that says, hey, if you work for me until you reach a certain amount of retirement, which is usually based on some formula such as 20 years, 25 years, could be less, we'll pay you a benefit based on the time that you've worked here, your average salary towards the end, etc., and we'll pay that to you. Usually it's for life if you work for the government. In some cases, you'll see in some of our examples, it's shorter. So I want you to think about that for a second. We've got to estimate today both expense and a liability for something that's maybe 20, 40 years in the future. We don't know if the employee will work for us that long. We don't know what they're going to be making at the end. We don't know how long they're going to live after they start receiving their pension. And so we've got to make a ton of assumptions to come up with this accounting. And that's what makes this chapter more complex. So again, right, pension benefits, they're cash payments to retired employees. And remember, we've got our two different types. The purpose of this slide is just to reiterate the fact, don't let it overwhelm you with all these lines and boxes, right? The employer, right, is going to give cash over to the pension trustee. And that could be, like we said, like a company like Fidelity, Schwab, etc. It's your cash once it gets there, right? The employee may also contribute cash there. And then what is the employee doing? Well, they're working for the employer, right? So that's a pictorial of those different pieces. Again, defined contribution means we're limited to the amount that we're putting into our employee's account. We make no promises about future retirement benefits. That's important because really once we give that money up, it's the employees to do with as they want. It usually at most companies tends to be set up in the form of some type of match. So if you put in a certain amount, they'll match it. And again, really want to encourage all of you guys to do that when you start working because it adds up fast when you start early. Okay, so accounting for the defined contribution plan. Again, if we've got 500,000 in salaries, we've promised our employees that we'll contribute 5%, right? 500,000 times 5% is 25,000. We debit pension expense, we credit cash. We've given that cash to the manager of the pension or the 401k, such as Fidelity, Schwab, etc. Okay, defined benefit plan, again, as we said, it's usually based on some specific formula that's very specific to that company. But you're promising people some type of benefit when they retire, right? The employee is not managing this. The employee may not be putting their own money into it. But again, trying to forecast that benefit is pretty complex. So, a couple different terms when we're talking about these defined benefit plans. And you're going to need to get used to these because we're going to work with them the whole chapter. All right, the one you're going to hear about the most is this thing called the PBO, or the projected benefit obligation, right? So that's the present value of the benefits attributed to the employee service, right, as measured by the formula, but we estimate what their future salary levels will be. Okay, so that's important. So we're assuming that they've, vested in it. We are assuming that we're at future salary levels. Okay, step down, and when we've got the accumulated benefit. Here, we're going to assume current salary levels, okay? But we're assuming all vesting, right? So remember, PBO has future, right? Future. ABO has current. And then VBO is going to be the smallest up here because you're using current salary and you're just limiting it to how much has vested so far, right? So you would expect a PBO to be the highest amount, right? Because it's based on future salaries. Again, we're measuring our pension obligation. The ABO based on current salaries, but still assuming we vest, so it's going to be a little less. And then VBO is going to assume current salaries and limits to how much is actually vest. So that'll be the smallest number. So let's go through a demonstration on this. Again, this is in your book, but you can follow along on these slides as well. So we've got Nicole. She started working at a company January 2020. Her starting salary is $45,000. She's expected to retire in 2044. At that point, it's estimated her salary will be $150,000. And in this case, benefits vest on a schedule. So 10% after the first year, 15% after the second year, etc. Here we've got a retirement period, meaning they're only going to pay Nicole for 10 years. That tends to be unusual. In a lot of these older pension plans or these government-funded plans, it really is for life, between the time you retire and the time you pass away. So their benefit formula at this company, so remember, every company is different, is it's 2% times the number of service years times the final salary. So what will we do with all that information? First, we're going to try to compute all of those pieces we just talked about. The VBO, the ABO, and the PBO, right? So how do we get each of them? We use the formula from the previous page, right? And again, formulas are unique to each company, right? So remember, PBO is going to be our highest because we're assuming the future salary and we're assuming everything's vested. ABO is going to be next in line because we're assuming current salary, but everything vested. And then the VBO, the vested benefit obligation, is using current salary and only the piece that's vested. So when we do that, we end up with $90, $900, $3,000. Easy math so far. How do we turn those obligations into a liability? Well, we're going to compute the present value of each of them. So I want to just walk you through this so that you understand how we're coming up with these liabilities, right? So again, we're assuming she retires in 2044 and that it's just a 10-year period. So starting January 1st of 2045, we owe her a certain amount of money each year for 10 years, right? So we need to figure out, okay, what's that liability that we would need to have on that date that'll pay out that certain benefit over those 10 years, right? And so in our first scenario, the VBO, right? If we go back to that previous page, we know that, hang on, let me go back to the previous page. Right, we knew the VBO was calculated to be 90, right? So I'm going to use the PV, and if I need a payment of $90 every year for 10 years at a rate of 10%, then I need $553 on December 31st, 2044. Right? If I use the ABO payment of $900, I need $5,530 on December 31st, 2044. And if I need a payment of $3,000, then I need $18,434. Remember, that's how much I need on December 31st, 2044 to be able to make those payments. I'm not at 2044. I'm back here in 2020, so I got to PV these amounts we just came up with back to today's dollars. So again, when I come up with my PV back to today's dollars, remember, for the VBO we needed 553, so that's $56 in today's terms. For the ABO, I needed 5,530. That's $561 in today's terms. And the PBO, which remember is our highest, that's our pension benefit obligation, I need to have $1,872 in liabilities today to assume that I'll be ready to pay out this $18,434. So that's the overarching concept of how we come up with our obligation, right? And you can see PBO obviously is the highest amount because it assumes that highest salary at retirement and everything is fully vested. All right, I'm going to pause there just to make sure I can get these videos done correctly, and I'll come back and do 19-2.